The relative health of the Australian economy was highlighted this week with its largest bank, the Commonwealth, posting a record profit of almost $7 billion. The result also draws a line under the 6-year tenure of Ralph Norris running the bank, and it now finds itself in the world's top 10 by capitalisation as its global peers had their value shredded this week. I spoke to Ralph Norris just after he released the results. Ralph Norris, you've been cutting your fixed mortgage rates this week. Do you think you might be cutting variable rates by the end of the year?
Well, that depends on the Reserve Bank as to whether...
Yeah, that's right. I'm just wondering what you think. What do you think?
Well, I mean, at the moment, if you look at the inflation situation, inflation is still sitting at outside the top of the band. So, if the Reserve Bank is focused and continues its focus, which is obviously the object of monetary policy on inflation, then it's hard to see that there would be substantial cuts.
Right, so what do you think? Do you think that the next move will be up or down? Obviously, there's a bit of a debate
I think we're going to go through a little period of time as to the Reserve Bank making a decision as to which way the economy is going to go. Obviously, we've seen a lot of dislocation around markets over the last week or so, and certainly I think once the dust settles, then we'll get an idea as to where rates will go from here, whether they will go down or whether they will go up.
Have your views about the economy changed at all in the past couple of weeks?
No, I mean, I think the underlying Australian economy is in pretty sound shape. I mean, when you look at the unemployment situation, you look at the strong wages growth that we've had right through the last decade, and you look at the savings rate, you look at terms of trade, all of those factors would suggest that the economy should probably be a bit stronger than it is.
Can't be said that the economy is in fine shape, can't be said of the rest of the developed world, Europe and America in particular. What are you most worried about, European sovereign debt or US recession?
Well, I think the US recession has the potential to have an impact on China, more of an impact, and certainly when the US is the largest consumer of product out of China, so that obviously has an impact potentially back on Australia because of the tight linkage that we have into China these days. So that would probably be my biggest concern. I think as far as Europe is concerned, the Europeans at some stage have to undertake some form of structural reform in the way that they structure their sovereign debt, and certainly it's going to happen at some stage. It's just when they decide to bite the bullet.
Obviously there's concern about a potential rerun of the credit crisis of 2008, which had the potential to impact Australia's banks because of your reliance on wholesale funding from global markets. Do you have a disaster strategy for if that does happen? If Italy does, for example, default, it all goes pear-shaped, and the markets do close up again?
Well, what we've been endeavouring to do is to make sure that we've got a very much a bulletproof balance sheet. So that's meant that we've looked very carefully at our exposures, and so certainly we have had no appetite for European sovereign debt. Likewise, we've looked very closely at our counterparty risk to make sure that the organisations that we have relationships with are going to be banks that will be solid and robust in times of uncertainty. And likewise, we're carrying a very significant level of liquidity, and we've pre-funded in order to make sure that we don't need to go into markets for periods of up to 3 to 6 months in order to make sure that we don't end up getting caught if things were to go really pear-shaped.
Right, so how long before you have to go to the markets? If markets closed up, how long would you be okay for?
Well, it would be a matter of several months.
Leaving aside the gyrations that we've been seeing lately, there's clearly a movement around the world, which includes Australia, towards more saving, less borrowing. Households, governments and corporates to some extent are looking at repairing their balance sheets. Do you think your successor is going to have to be running a different bank in a different environment to the one you've been running?
Well, I think it's fair to say that over the last 5 or 6 years we've seen a whole range of different environments which have led to lesser or greater issues for the business, and I think that that's just part and parcel that goes with running a large organisation. And I remember being asked, when I took on this role, the first press conference, how was I going to get double-digit income growth or net profit growth over the period of my time, and I said, well, it was aspirational, and the
turned out to be easy.
Well, it turned out to be probably
easy for a while at least.
But a little easier than people would have thought back in 2005. So I think markets change, they evolve, and we've got a business that is quite diverse in the range of activities that we undertake. And you always have a situation where some of your businesses are performing really well and others are performing less, and that's one of the advantages of having a diverse financial services business, and one that operates in 11 countries, but obviously primarily in this part of the world at the moment. But over time, we're obviously increasing our exposure to other markets.
In what way? Do you have particular markets in mind that you think you're going to target?
Well, certainly if you look at our CFS GAM business now, 54% of its income now comes from offshore. We're seeing an progressive increase in the earnings, a proportion of the earnings that are coming from markets such as Indonesia, China, Vietnam, and the like.
Any thought of making acquisitions in some of those markets?
We've obviously made acquisitions or taken positions over the last 4 or 5 years, and we will make acquisitions into the future, but they have to be ones that make sense and tend to probably be more opportunistic than going out and paying a large price for something. I think that it's all too easy to go and make acquisitions that end up not covering their cost of capital and being shareholder negative in regard to accretion.
Just back to the local banking market, I mean, CBA has been actually losing market share, just slightly, both in mortgages and in deposits, and it would seem to have been going to NAB. They've been quite aggressive with their strategy, which seems to have been coming off. Their growth has been double system growth. Is that going to lead, do you think, to a need to change strategy here?
Well, I think you can look at these things on a relatively short-term basis. I mean, if we go back to 08, 09, 010, I mean, we were growing at around double the market ourselves. So, and so we may have lost a little bit of market share at the margin. But if you go back and look at our market shares and all of our businesses as to where they were back in 2005, when we had about 18% market share in the mortgage business in 2005, today we have around 25% share. So, you've got to look at these things over a period of time, not on the basis of...
Yeah, but you're only as good as your last 12 months, Ralph.
Well, I think the issue here is that over the last 2 or 3 months we've been improving our performance in that regard, and certainly you can take on profitless growth. There's a lot of companies that have done that in the past. And
do you think that's what NAB is doing?
Well, I think that you look at some of the figures and have a look at the growth in the retail bank and the growth in the bottom line.
Thanks for joining us, Ralph Norris.
My pleasure. Thanks, Alan.
And all the best in retirement.
Thank you.